Yes. Good afternoon, friends, and welcome to yet another interesting session. And in this particular part of the conference, we are going to discuss the global aspects of global developments in taxation of digitized economy. Friends, it gives me great pleasure to welcome the esteemed panel chaired by Advocate Mukesh Bhutani, who would be doing a fireside chat with Mr. Pascal. We are indeed grateful to Mr. Pascal for sparing his valuable time for this conference. And post that, we have esteemed panel who will discuss the issues regarding the taxation of digitized economy and the recent developments at OECD Pillar 1, Pillar 2, and the related developments. The panel we have our guest, Mr. Carlos Proto from the Argentina. He is in the Ministry of Economy, International Tax Relations, and right now at his place it is 6:30 a.m. We really salute your commitment, sir. We have a senior IRS officers, CCIT, Mr. Rajat Bansal, and C. Radhakishan Raval. We have esteemed panel and we look forward to learning a lot from them. So without taking much time, may I request Ganesh Rajgopalan to introduce our speakers, chairman, and the panelists. Thank you.
Good afternoon, everyone. Good morning, Carlos. So it's my pleasure to formally introduce the esteemed panel. Though, of course, there's a more elaborate introduction available in the material shared with the participants. It is I'm taking this opportunity to introduce them for the today's discussion. I'll start with the chairman of this technical session, Mukesh Bhutani. He's a founder and managing partner of BMR Legal, a law firm which specializes in domestic, corporate, international tax and transfer pricing. He has over 3 decades of experience in advising multinationals and Indian conglomerates. He has participated in many committees of the Indian government and deposed before them on host of tax issues pertaining to e-commerce, APA, safe harbor, GAR, indirect transfers tax, and in particular, he has also participated in the Kelkar task force on tax reforms. He has to his credit several judicial pronouncements in Indian tax tribunals, high courts, and Supreme Courts, laying down landmark principles of law and treaty on transfer pricing and law. He was a member of the Tax Bureau of OECD BASC, Permanent Scientific Committee member of the IFA for 2012 to 2016, and is presently the chairman of IFA India branch. He has to his credit several authorships on topics of domestic tax, tax treaties, transfer pricing, treaties, and GAR. He is a visiting faculty for LLM in international tax and advanced transfer pricing program at Vienna University and several other international organizations. I request all the participants, all the delegates to welcome Shri Mukesh Bhutani. Then we have Pascal-Saint Amans. He is a director of Center for Tax Policy and Administration at the OECD. Mr. Saint Amans has joined OECD in September 2007, where he played a key role in the advancement of the OECD tax transparency agenda in the context of G20. Prior to his appointment as a director, he was head of Global Forum on Transparency and Exchange of Information for Tax Purposes since 2009. He has been very instrumental, and in the entire BEPS project, we have been seeing him right at the forefront, leading the project. So we welcome Pascal-Saint Amans. Next, my pleasure is in inviting Shri Rajat Bansal. He is a senior IRS officer in the position of Chief Commissioner of Income Tax. He was amongst the first transfer pricing officers in India. He was the India's competent authority for the period 2014 to 2019 for treaty negotiations, MAP, APA negotiations, and exchange of information. He has negotiated several of India's important tax treaties, some of them being Mauritius, China, Chile, Brazil, and Hong Kong. He concluded and signed India's first bilateral APA with a Japanese taxpayer. He was a member of the UN Tax Committee on Cooperation in International Tax Matters in his expert and personal capacity for the period 2017 to 2021. He was also the architect of the famous Article 12B, the Rajat Bansal proposal on taxation of automated digital services, which was approved for insertion in the next update of the UN Model Tax Convention. Please welcome Rajatji for this panel. Then we have Carlos Proto. He's got a bachelor's degree in economics from University of Buenos Aires, Argentina, and a master's degree in tax management from Brussels School, Belgium. He's a tax treaty negotiator for Argentina. He's a director of international tax relations at the Argentine Ministry of Economy. He's a representative of Argentina at the OECD Committee of Fiscal Affairs and its sub-organs. He is a representative of Argentina at the OECD Inclusive Framework on BEPS and current member of the steering group. He is also a member of the Mercosur Group of Tax Experts. He is and a member of the G24 Working Group on Tax Policy and International Tax Cooperation. He is also a member of the UN Committee of Experts on International Cooperation in Tax Matters. Please welcome Carlos. And a big thank you for your early morning effort. And last but not the least, we have Mr. Radhakishan Raval. He is a partner in Deloitte India. He is not only a chartered accountant, but also a cost accountant and a company secretary. He was a former committee member or subcommittee member of the United Nations Committee of Experts on International Tax Cooperation in Tax Matters, and he actively participates in the UN Tax Committee. He was invited for the ambassador level closed briefing conducted for permanent representatives of G77 in Geneva, organized by the South Center and FACTI panel. He has authored several books focusing on international tax issues, which has been published in India and abroad. And he is he has also released books containing his analysis of the provisions of the Finance Act on a regular basis since last 4 years. We welcome Radhakishan. Mayur, we can't hear you, please.
Thank you, Ganesh, for that elaborate introduction and welcoming the guest. I once again welcome all of you. I welcome our guests who are watching this session live on YouTube as well. And with this, I request and hand over the charge to the chairman of the session, Advocate Mukesh Bhutani. Thank you very much.
Thank you, Mayur, and thank you, Ganesh, for the introduction. Obviously, expectations are high that Pascal would be on the screen, which you can't see him. So, people may be disappointed. But the good news is that we have recorded an interview with him, which we are going to play it out, because a few days before this session, we were told by his office that the internet connectivity for him, he's on vacation, could be very bad. And we did not want to take any chances and disappoint any of you. So we have a half-an-hour fireside chat recorded with Pascal that we are going to play it out. But before we do that, and to set the context, the advantage of having such a learned panel is that they will get deeper into the issues. The disadvantage could be that people who are new to the subject of international tax or digital taxation, where we have seen so much development, could actually find it difficult to follow. So our whole purpose for the next 2 hours is going to be to take you from the basics to what really where we stand today, and more importantly, what we are likely to see in the next couple of years. The journey on digital tax, as I'll explain it to you, has been over 13 years, and this is what Pascal also mentioned. So I have a brief presentation that I wanted to take you through, and this will set the context for the Q&A chat that we had with Pascal, as well as with the panel that we are going to have after conclusion of that. So Mayur bhai, if you can just put out the slides, I will just keep on telling you to move the slides. All right. So essentially what we are going to do, next slide, please. If somebody asks, what is the inclusive framework? I will display this slide. Now, for many of us as Indians, we'll say khichdi. Or for many of us, if you look at it positively, it means that this seems like a menu of dinner for 100 people, over 100 jurisdictions that we are talking about. And the beauty about this menu is that pick a dish that will suit your dietary requirements. We need to bear in mind that we are dealing over here with a G20 mandate, which has now expanded under the inclusive framework to over 100 countries. And hence any form of solution that is being looked at has to have a menu choice based on dietary preferences of various countries. So I just thought I'll start with this. The inclusive framework as it stands today has 133 countries on the table, with the last edition that happened just 2 days back, which is Barbados. So I just thought I'll talk about that. Next slide, please. Before we get on to the whole agenda of digital taxation, I just wanted to lay the context to the larger BEPS agenda, and that most action points in BEPS agenda clearly lead to an issue on digital taxation. But before I do that, just if you look at the latest OECD survey, which came in the last week of July, it has thrown some very interesting statistics on the concerns of governments all across the world. It says that in the last 20 years, there has been a virtual war on bringing down the corporate tax rate. It has fallen by 8.3%. That's phenomenal. Just imagine if the world had remained at corporate tax rate of 28.3%, which is what it was 2 decades back, what would governments have been? Governments would have been, running to the bank, laughing. But that's not the real issue today. With this 8.3% fall, governments are really battling with increased corporate tax corrections. Some more statistics suggest that the rate as it stands today is between 10 and 20%. So it has gone up from 7 to 29 jurisdictions. So in 2020, there were only 7 jurisdictions which had 10 to 20% rate. Now we have 29 jurisdictions, and possibly India may fall in that jurisdiction. The 30 to 40% band has come down from a whooping 70 to 18. And there is no country which has a tax rate of above 40%, which 20 years back was 13 countries. So this is just to be able to explain the situation that governments are facing across the world. The other revealing part of the OECD survey is this whole issue of misalignment between the location of profit and the location of economic activity. And more importantly, countries from where investments are happening, which is what OECD has described it as an investment hub for multinational enterprises. Their relative share of profits is 26%, but the number of employees that are located over there is 3%, and the tangible assets in the jurisdiction of the investment hub is 14%. So this is just to be able to explain the misalignment between the investment activity and the location of assets and the employees in those investment hubs. Next slide, please. Now, let's look at the big picture of the BEPS. We all know that one of the important ethos of the BEPS is to come out with a new taxing right, which is given to the marketing jurisdiction. However, interestingly, if you look at the history of the treaty network from the point of view of the League of Nations report of 1923, I'm going to read out a statement from the League of Nations of 1923, which seems to suggest that even in 1923, the nexus principle was talked about. However, it took us almost 100 years to be able to implement it. And I quote the League of Nations, it says the oranges upon the trees in California are not acquired wealth until they are picked, and not even at that stage until they are packed, and not even until that stage until they are transported to the place where demand exists, and until they are put where the consumer can use them. This is a 1923 statement which focuses on a statement of League of Nations as to the importance of consumers. Coming back to the big picture outcome, many things have happened, whether it is by way of the minimum action plan of the principal purpose test or by way of adoption of action point 14, where countries such as India clearly were missing in action with regard to accessibility of map data, or for that matter, any form of binding resolution. I'm not on mandatory arbitration. I'm talking about the binding resolution process. And we will look at it later on when we talk about it in the context of digital tax amount A, how we have made a beginning or a start to embrace some form of a binding dispute resolution process, which is on the face of it mandatory. And more importantly, a multilateral framework, which was unheard of. The other aspect that keeps on getting missed in this whole debate is the OECD's action plan on unfair tax practices that are pursued by nation. And those are aspects which have also been, in a view, flagged off in various peer reviews. Go ahead, please. Where does India stand in this debate? Since we are having this conference under the aegis of Bombay Chartered Accountants Society, it would be unfair to move to the global debate on international tax without talking about where does India stand. Well, the equalization levy and the SEP test legislative moves are nothing but a small answer to action point 1, but it doesn't stop over there. There are other moves as well that have been listed down. Some of them may not be entirely connected to digital tax, but they are important moves where India has tasted some form of a review. So if you look at India's patent box regime, which is nothing but in pursuance to action point 5, we went through a review and the peer review has cleared that. More importantly, the incorporation of the principal purpose test now in section 90 becoming an integral part of the treaty is another important change. And we have seen many changes to the domestic law on 911 on the agency principle and amendments to the definitions that we have seen. I'd just like to mention one important aspect, because Mr. Bansal is here, is the detailed map guidance which he authored before he moved to his principal chief commissioner position, which is the May and the August 2020 detailed guidance that has been issued by the Department of Revenue. All of this were in pursuance to the peer review process. Next slide, please. So what is the OECD's outcome on unfair tax practices? Well, the OECD, as a part of its review, and you will see it in the next slide as well, has examined all forms of regimes, whether it's got to do with headquarter regime, intellectual property regime, regimes that have finance and leasing and banking and insurance fund. Even India's special economic zone and free trade zone agreement also came up for review. Interestingly, OECD found that India met the requirements. However, the WTO did not find so. So if you look at it, India currently has an appeal before the WTO panel on its SEZ and other forms of free trade zone agreements that are incorporated in the domestic law. The numbers are humongous. 106 out of 309 preferential tax regimes examined by the OECD have been abolished, 53 have been amended, Even countries such as United States and Australia were not spared, and their regime dealing with offshore banking and other forms were blocked, including a commitment that United States has given to abolish some of its regime. India's preferential regimes that came up for examination include the patent box regime, the SEZ, including tonnage tax. I was not aware of it, and including some of the newly legislated rules on offshore banking and IFSC regulations as well. So this is just to be able to give you a flavor. Next slide just lists down how these regimes have evolved over a period of time. What is the scorecard for these 309 regimes? You will be able to put in perspectives many of the things on the BEPS agenda and the digital tax agenda if you have all of this in your background. Next slide, please. Now let's come to more specific on digital taxation. In the international tax policy fraternity, there's sometimes a joke as to where we stand today. Is it a BEPS 2.0 or is it actually a 3.0? And I'll just explain to you what is BEPS 2.0, because we know BEPS 1 was really the Action Point 1 report, but we never got anywhere at Action Point 1 report. But the Action Point 1 report did not in any manner hesitate in acknowledging that there are no solutions. And it essentially laid down some of the solutions it could think of at that point in time, the alternatives, whether the equalization levy or whether the withholding tax or any form of indirect taxes, all of these were coming through BEPS Action Point 1, which is a 2015 report, which is called BEPS Action Point 1 report. Thereafter started the exercise of the interim report release of 2018, and people started talking about the BEPS 2.0 regime. And after the October 2020 report, wherein we all thought that the OECD blueprint on the two-pillar solution will form the basis for the future of digital taxation at a time when US had withdrawn from the negotiations, we thought that that would lay the framework, but that changed. And that changed partly because of the change in regime, US coming on board, the G7 communique, and that now is being considered as BEPS 3.0. So this is really the journey. We are far beyond BEPS 2.0. What we agreed in the OECD blueprints of a two-pillar solution less than a year back is now radically changed. And I use the word radically with a lot of care and caution, because when you see these changes, you will perhaps also come to the same conclusion. Pascal doesn't agree with it, but my view is that we are radically changed from October 2020, and that's the reason I label it as BEPS 3.0. Next slide, please. So let's come to some of the design aspects now of Pillar 1 and Pillar 2 before we get on to the Q&A session with Pascal and also have the panel discussion. I think most of us know this. For the sake of clarity, I have just tried to simplify it. There were, even before the blueprint came out of October 2020, there were Amount A, Amount B, Amount C. In October 2020, we came to Amount A and Amount B. Amount B being what you see today as a regular distributor margin, or what is called marketing and distribution functions, being measured on an arm's length basis for all forms of businesses. Amount A is your new taxing right, by which the market jurisdictions will tax a portion of what is called a residual profits, and those percentages vary. We are going to talk about it, and it will apply to the largest and the most profitable businesses. Again, changes that we saw from the OECD blueprint of October 2020 to today, but the footprint and the design remains the same. But there is an important other principle, which is the principle of tax certainty. And it's not a two-pillar design, it's a three-pillar design, because tax certainty is paramount. It will ensure that Amount A in particular has tax certainty. We will try and debate as to why Amount B does not have tax certainty, and countries such as India, will find themselves in a slightly difficult position because we already have a lot of disputes on amount B. Next slide, please. I'm still on the blueprint proposal, but now I will move from the blueprint proposal also to show you the new proposal, which is the inclusive framework statement. This is a statement which was made just last month on July 1, and this forms the basis. The blueprint proposal simply did not distinguish between automated digital services and consumer-facing businesses. The reason I point it out is because there is a UN proposal which focuses on automated digital services. On the other hand, the design under the inclusive framework is with a focus on world's largest multinational organization. To start with, companies with a turnover of 20 billion euro and profitability about 10%, and then this threshold gets reduced in 2031 to 10 billion. And there are carve-outs for certain forms of mining and extractive industry and certain regulated financial services. And so this is really the main design of the inclusive framework, which is going to form the basis. Next slide, please. The inclusive framework equally emphasizes on tax certainty. So this is the common issue. But here comes the catch. Though the tax certainty is being talked about, it's being talked about in the context of amount A. And the resolution that is being thought about for amount B is not under the multilateral framework. However, there are statements that are made that it would be through the safe harbor provision. Now, we do not know how these are going to come. We are yet to see how these safe harbors work. But my responsibility here was to be able to point out that the blueprint of October 2020 on tax certainty focus very clearly on the tax base, the result of the implementation of the formula, and any other feature, including new rights that could be given to countries over a period of time. The latest statement is silent with focus only on amount A, and focus on amount B is only with respect to safe harbor. The other important element where India is not really impacted is the exception for mandatory and binding settlement insofar as amount A is concerned. This will apply to certain nations, which is called the developing nations, and it's what is called as the elective dispute resolution mechanism, where certain economies have no or almost no experience on MAP, and they do not have a history of MAP, or for that matter, any complex dispute resolution that they have handled. And these are the jurisdictions that will get covered, like Kenya, Malaysia, Pakistan, Botswana. It doesn't impact India, so India will clearly fall in the mandatory arbitration process. But I just thought that one of the important features I will explain, which is the elective binding dispute resolution process that has been given out. Next slide, please. Let's come to amount B. Now, amount B, as I had mentioned, talks about an arm's length outcome for marketing and distribution function. The statement makes a categorical affirmative, kind of a acceptance that it would be simplified and streamlined, thereby suggesting that there is some work to be done. Clearly, the focus would be on low capacity countries. Now, interestingly, they've used the word low capacity countries with no guidance as to what form of countries will fall in that category. But it clearly says that there would be a safe harbor, and this safe harbor will be an important determinant to be able to minimize disputes arising out of amount B. And this work is expected to be concluded by end of 2022, which means that the next set of OECD guidance that would come on digital taxation will not have any certainty on amount B. And this is something that we in India have to watch out on because of the growing disputes on the marketing and the distribution function. Next slide, please. I'm not going to go into the key components of Pillar 1, other than emphasizing on 2-3 important principles. We all know the nexus principle is going to be important. On quantums, the range is 20 to 30%. The G7 communique talked about 20%. Subsequently, the OECD statement talked about 20 to 30%. Clearly, that seems to be the disconnect between the G7 communique and the OECD. OECD obviously recognized what the G7 communique was, and some of the figures that people are working out are on the 20% of the residual profits. But if it is 30%, then clearly the market jurisdictions will have the ability to tax more. And clearly I can see the pressure that is coming from large consumer driven economies to push it to 30%, but OECD has right now kept it as a range. The tax-based determination will be based on the financial accounts, so that's relatively simplified. Of course, there would still be situations, but in the era of IFRS, we should assume that there would be lesser of an issue if your tax-based determination is based on the international financial accounting standards. Segmentation will only be on an exceptional basis. This is slightly at variance to what the US Treasury had suggested. Unilateral measures would be implemented in a coordinated manner, and the implementation dates are also specified. We will try and get answers to some of these questions from Pascal, so I didn't want to steal away the thrill. We also have a panel, but I just thought in the interest of time, we should move ahead. Next slide, please. Now, many people have been asking, what would be the impact of implementation of the two-pillar solution? First, let's look at Pillar 1, because some form of impact analysis has been done. The two impact analyses that appeal to me the most, and I displayed first, is this piece that Mukesh Bhutani from PwC's Washington, DC office put out. And he's got some very valid assumptions on what the impact would be. Now, this chart throws up some very interesting things. It's actually put down, the number of MNEs who have residual profits. So the US MNEs have residual profits, actual residual profits. He's taken an average of 3 years of $51.73 billion, and it goes down. So the total residual profits of all MNEs which would get allocated would be $83.55 billion. The share of amount A has also been mentioned over there. Now, interestingly, the third slide talks about the share of global nominal GDP. So, US contributes 24% to the total GDP, China 17%, and so on and so forth. And then the last slide is the potential number of in-scope MNEs in the group. So United States has 41 MNEs, China has 7, the non-US GE has 19. Now, if you see this chart clearly, US is giving away a substantial part of its profits, which either it would have taxed in the United States, or the US companies would have not paid taxes by keeping this income outside of the United States, subject, of course, to the new domestic regulations. China, on the other hand, with only 7 in-scope MNEs, in-scope would mean MNEs that would fall in the threshold of the $20 billion, and will give away only 9.2% of the share of amount A, because its residual profits has a very low base. Similarly, the non-US G7 multinational enterprises, which are 19, which are outside of the US but form a part of the G7, who contribute 21% to the nominal GDP, are giving away 9.8% of the total. So this also explained the angst of the United States as to why there was a lot of reluctance, and more importantly, until and unless we see the final shape of the two-pillar solution, why the US thrust for Pillar 2 rather than Pillar 1, because this is the outcome of Pillar 1. Next slide, please. There are many issues, open issues on Pillar 1. We've kind of randomly put down what those issues are. Some of them are known to us. Some of them would arise as we go ahead. Things like the adjustments to financial accounting statements, I guess all of this would get answered in our journey to the resolution process. But what are those exceptional circumstances that will allow segmentation? To what extent carry forward losses would be allowed? So on and so forth are some of the questions. We did pose some of these questions to Pascal. We did get an answer to some of them. Specifically, I was interested as to how will the implementation work? Will there be a new set of the MLI agreements? And if there are, how will the existing MLI interact with the new MLI? And his answer was, we are just looking too much ahead. Let's wait for this consensus to settle down and we'll look at it. But clearly we know that there would be some form of a multilateral instrument, which is what everybody has been talking about. Finally, my question on OECD timelines, aren't they ambitious? To which he felt very, very confident about it. But let's try and hear it from a panel as well, how we seek a resolution to the open issues. Pillar 2 design, tricky one. It's tricky actually for many, many Indians because we are not used to many of these. I wanted to just make 2-3 points over here. We could see a whole lot of US domestic law provisions coming in, and hence the preference of United States for Pillar 2 design. The Pillar 2 design envisages one, minimum taxes, and we heard about it so loudly in the G7 communique that there has to be a 15% domestic tax. But it doesn't end over there. It has two distinct pillars, or rather two distinct elements of Pillar 2. One is the subject to rule tax, and second is the globe rules. By the way, all of these have been identified, and there are a lot of similarities between the globe rules and the US domestic law provisions on GILTI and BEAT, which came in as a part of the tax and job cuts in 2018, which is a complex set of anti-avoidance measures that are there. However, all of those will, over a period of time, come in through some form of a multilateral network, depending on to what extent the world under the multilateral system embraces the Pillar 2 proposals. So clearly on the subject to tax rules, it simply says that the source jurisdiction will impose a limited source taxation on certain specified forms of payments, which it will subject it to tax. Of course, this tax will be creditable in the country of residence. The GLOBE proposals contain two interlocking domestic rules, or rather driven by domestic rules. One is the income inclusion rule, and the income inclusion rule would mean that it imposes what is called as a top-up tax on a parent entity with respect to income derived in a low tax jurisdiction in a constituent country, which is the source country. And the second rule is the undertax payment rules. Under the undertax payment rule, there would be a denial of deduction to the extent the low tax income of the source entity is not subjected to tax under the income inclusion rule. So the two interlocking domestic rules will play out in a Pillar 2 scenario. Next slide, please. I'm not going to elaborate further on this slide, but this further goes to explain the Pillar 2 proposals and how they would interact. Suffice to say that it is not mandatory for the members to apply the GLOBE rules, whether they are coming in through the income inclusion rule or the undertax payment rule. However, if a member applies for the GLOBE rules, it would need to be consistent with the model rules and guidances, and it should also accept GLOBE rules applied by other members as well. So there could be some form of a multilateral framework to be able to make sure that these rules are applied consistently. Next slide, please. Fairly exhaustive list of questions on Pillar 2, not just insofar as the overall design is concerned, but how will the rules work? There is very little visibility on that, but we just felt that we should put it down as a laundry list of issues that are there. Pascal did not get into in a major way into the Pillar 2 proposals, because he also said towards the end that countries will have to work very hard, and the effective date is 2023. We will cross the bridge when we get there. So I just didn't want to talk about it, but just flag off all the important issues that are there. Next slide, please. This is my last slide. The pillar, just from a Pillar 2 perspective and the acceptance of Pillar 2, even within the US, the Congress has expressed concerns. One, with regard to the coexistence of the GILTI and the BEAT regime. As I mentioned, this came in 2018, and how the GILTI and the BEAT regime interact with the Pillar 2 proposals. One would have thought that US would have amended the domestic law to take away the GILTI and the BEAT regimes, because the GLOBE proposals do resonate a significant part of the US domestic policy. But I think US has said that they will coexist. And then besides the tax rate of 15%, the tax base is equally important from a US standpoint. This remains unaddressed. And some of the questions that we tried to raise were, is it truly a global agreement? Because we see that 3 of the EU countries are still not, they're important from a vetoing standpoint within the EU member states, but they are not a part of it. Not to forget Nigeria and some of the other economies which are significant, having not accepted the 15% global minimum tax. We did ask Pascal to shed some light into it, which he has done. But let me stop over here, and instead, let's try and hear to some of the questions that Pascal answered us in relation to the questions that we have put forth to him. So Mayur, if you can just display that video, we'll probably be able to hear what his views are.
Welcome, good afternoon to this special session that we have with none other than Pascal-Saint Amans from OECD. Thank you very much, Pascal. This is a privilege and an honor for me. We truly appreciate you taking out time from your hectic schedule, particularly where you are today, and French vacation time as well. Firstly, accept our heartiest congratulations. The world is closer than it has ever been at this point in time, reaching to a mutual understanding on new age taxation rights as well as global minimum taxes. You seem to have a Midas touch when it comes to getting countries together. First, exchange of information on treaties. Now, Action Plan 1 being taken to its logical conclusion. Wonder what it takes for you to get so many heads of states together, and more importantly, get politicians to agree. One can only imagine the chaos that would be emanating if it does not go through. Trade wars, retaliatory taxes, possibly a general contraction in global trade. Before we delve into the questions, tell us how you managed to make so much progress in the midst of global pandemic and in the absence of in-person meetings. Do you think this would have been resolved sooner had the pandemic not struck us, or did it take a different kind of political will from the United States to make it happen?
Thank you, Mukesh, for the invitation. I'm very happy to be virtually with you, and I really hope that one day it will no longer be virtual but physical. Yes, we've never been that close to an agreement. I say we actually have an agreement. We need to finalize it. There are a few numbers to firm up, but we do have an agreement. And I think the reason why we have an agreement is that it's not because of a few months of work. It's because it's the achievement of almost 13 years of work. All that dates back to the global financial crisis in 2008, which was a wake-up call for the world. Leaders, finance ministers, and the people in the world woke up and said, we've had globalization, But there was something which didn't go well with globalization. Actually, a few things didn't go well, but one of them in tax, because that favored tax havens, investment hubs, and that deprived taxing countries of their sovereign right to tax the companies or the individuals the way they wanted. And that's where the G20 turned to the OECD, because we were the organization which had worked on that and which was ready and able to move fast on this, to address what I would call the tax haven issue, with one aspect which was putting an end to bank secrecy. And then in 2012, we took the initiative, by anticipation of a political request, to work on the taxation of multinational companies. That goes much beyond the so-called tax haven issue. It's more about reallocating taxing right, having more fairness in the international tax system. I would summarize it in introducing some form of tax regulation of globalization. And that's what also I call the tax paradox, which is cooperation, which can be seen as a limitation to sovereignty in other fields. In tax matters, cooperation means strengthening the tax sovereignty of countries. And that's why it's been a winning story for the G20, a success story. Now, as you've said, the COVID crisis has made things more difficult, because we've worked virtually, and you cannot achieve the same level of trust or dynamic virtually than what you would do physically. However, we've been able to put a lot of work for the past 2 years, 3 years on this. Interestingly, the Trump administration opened the door to a negotiation in 2017 with a tax reform, and they allowed the world to think of a reallocation of taxing rights on the one hand, and of introducing a global minimum tax on the other hand. And this was a legacy of the BEPS project, because the Trump administration implemented the BEPS project. So you have a number of paradoxes there. And then we started working, but it is true that with the Trump administration, there was, to use an understatement, some hectic moves. And after moving fast, we stopped, and we had the so-called safe harbor proposal, which was kind of making tax a choice for companies, which was not acceptable to everybody. But we've been able to build the basis for further negotiation. And what really made the difference for the past 6 months has been the incoming Biden administration. This administration made this issue a top priority, not only on the global international agenda, but on the domestic agenda, introducing a global minimum tax and agreeing on pacifying the tax relationship across the world, and therefore agreeing on the Pillar 1, on the reallocation of taxing right, has been the trigger for fast progress, in spite of the COVID crisis, in spite of the delegates being tired of having worked on that for years, and in spite of the public at large having serious doubts on whether we would be able to agree anything, anytime. And a couple of weeks ago now, 3 weeks ago precisely, we had 130 countries agreeing on an equal footing on a new frame. We now need to design the rules to implement this new frame, to finalize this political agreement by October. But whatever happens now, we've turned the page. We've turned the page of the League of Nations time, of the Model Tax Convention as we used to know it. It's been years of work to be able to turn the page, but now the page is turned, and things will never be back to what they used to be, I think.
Tell us more about the ongoing consultation process with developing countries on assessing the progress with BEPS action plans. I know that there are several important areas of work which are very specific to emerging markets, besides, of course, the bigger digital taxation and the global minimum tax. Has the combined impact of the overall benefit been instrumental in the compromise approach to Pillar 1?
Yes, that's the short answer. I can develop a bit. I mean, the first thing, and I know there are many people doubting it, including in India and other emerging economies, that this is an OECD project with the OECD countries, that the G7 kind of pre-decided everything, which is wrong. it's not the truth. The truth is that until the BEPS project, we were largely in an OECD context. With the BEPS project, we moved to OECD and G20. And I do remember a G20 finance ministers meeting in July 2015 in Moscow, where the then finance minister of India said, no, I cannot agree this. I want to be able to make some changes as necessary. And the last minute in the room, I had to go to different finance ministers to finalize the deal. And that started an era where the G20 countries were really on an equal footing. And then with the inclusive framework built in June 2016 in Kyoto, with the inaugural meeting, we have developing countries on an equal footing. That's a fact. And the reason why I emphasize the fact is not just to be defensive against criticism, but rather to make people understand that the dynamic of a negotiation with 139 countries is not at all the same as an OECD dimension or G7 dimension. Now, it is true that you have different groupings. The G20 is a grouping of 20, actually 19 countries plus the European Union. You have the G7, and these people talk to each other, but the G7 agreement would lead nowhere because it would just represent the interest of a small group of capital exporting countries, and they have to compromise then with the emerging economies. But even negotiating with India, and I have to say a few words on Rashmi Das, who's really, I mean, one of the best, not to say the best, I don't want to miss anyone, but Rashmi is clearly extremely smart, able negotiator, and has been able to bring the views of emerging economies. But you know, it doesn't do the job for small developing countries, which have also had their say. So overall, we had to compromise. And when you look at the agreement, at the statement by the inclusive framework, you can see all these different interests reflected, including those of OECD countries, which are part of the negotiation and represent a significant part of the global economy. But let's take a couple of examples. The nexus. 250,000 euros of sales for a company to be taxable in a country which doesn't have a permanent establishment. India didn't care. I mean, it could be 2-3 million given the size of the Indian market. That clearly is a reflection of the needs of small developing economies. The subject to tax rule as a minimum standard, and that's very powerful, is both a reflection of an Indian push, but also small developing countries in Africa. So yes, we did an impact assessment for everybody. The impact assessment showed that OECD countries will benefit in absolute terms more than non-OECD countries, but it's because of the size of the economy. So there is nothing wrong there. But what was very important was to show that developing countries would not only benefit, but actually benefit more than their share in the global economy. Now, some critics could say, well, but that's not enough, and we need to completely change the taxing rights so that developing countries get a much bigger share. But my response to that is, why not? But that's another debate. And two, well, why so? Is tax the right tool to actually completely reallocate taxing right across the world? Why would some countries completely give it up? Tax is not aid and shouldn't be aid. Now, domestic resource mobilization is important. The fact that we have a more balanced system, and it could be more balanced indeed, but is a significant progress. So the result of the negotiation is kind of the reflection of different conflicting interests, but what mattered and what matters, I think, is the fact that you have a very, very large majority of the countries which have agreed. Only 7 for the time being have not joined the consensus.
On the scope, Pascal, Action Point 1 has come a long way in terms of encompassing a all-inclusive, and in its current form, all industries, including airlines, shipping, hospitality, seem to be covered. There is, however, still an expectation. Would you leave certain businesses out of the scope? Is that a reality, or that's a speculation at this point in time?
So we have 2 different pillars and therefore 2 different scopes. On pillar 1, the carve-outs are for the extractive industries and for the financial service industry, regulated financial services. And that's it. So that's the agreement. That's where we land. There are good reasons for that. For extractives, for instance, the fact that the rent is location specific, and the location is where the extractives were extracted. So that's a very, very strong logic. As regards Pillar 2, it's only shipping, which is exempt. Now, when I hear people talking about exemptions on Pillar 1, I say, no, you get it wrong. It's not an exemption, because Pillar 1 is not about the minimum tax. It's about the reallocation of taxing rights. So the fact that some rights are not reallocated doesn't mean they are exempt. Extractives will be taxed, hopefully, in the countries of extraction.
Correct. Let's come to the new multilateral instrument. There's a lot of curiosity. How will the new multilateral instrument, which look like, which will have to be signed in pursuance to the two-pillar solution? But the bigger question in everyone's mind is, how will it interact with the existing MLI under the BEPS project, the so-called minimum standards? Any thoughts and views you can share with us on that?
Not really, because we are working on this. What I can say at a very high level at this point in time is that a multilateral convention, we think, is necessary for the implementation of Pillar 1, not for the implementation of Pillar 2, even though it could be a plus for the implementation of Pillar 2. And we think this is much more like a truly multilateral convention rather than the MLI, which is about matching countries and amending bilateral treaties. So I think here we're in presence of a new type of instrument.
In fact, my next follow-up question was, does the consensus amongst these so-called 130 countries also mean commitment by each one to implement the deal? Or is it going to be optional, like it was in the case of MLI, that despite consensus on all BEPS report, you may have options that will apply to you?
We'll see where we land, but I tend to think that what is a commitment, the commitment is about implementing Pillar 1, and if there is a choice of instruments to implement Pillar 1, nobody cares which one you choose, except that if you want to be realistic, there is a need to move fast. You will have seen that the agreement provides for an entry into force in 2023, which may be aspirational, but is very, very ambitious. And therefore, having a common instrument seems to be the right thing. As regards Pillar 2, this is not a minimum standard for the globe rules. The subject to tax rule is a minimum standard and will have to be implemented through bilateral treaties or multilateral convention. The globe rules are not a minimum standard. It's a common approach, which means that countries are not obliged to move into that direction. But if they move into that direction, these are the rules they need to implement. And the reason for this is that you cannot expect a zero tax jurisdiction to introduce Pillar 2. That wouldn't make sense. And that wouldn't make sense for these jurisdictions to be on the way of those willing to implement. So the common approach is more about securing a critical mass of countries ready to implement these. We do have this critical mass of countries, and therefore we move. There is an EU question, European Union question, because of 3 European Union countries, namely Ireland, Estonia, and Hungary, not joining. But we hope that by the time of the implementation, these countries will have joint consensus.
In fact, that was my follow-up question on Estonia, Hungary, and Ireland. But let's come back to implementation of Pillar 2. It seems that it would really mean disincentivizing corporations from moving income to low tax jurisdictions. Would one see a more liberal interpretation of anti-avoidance measures by the tax authorities? I mean, if Pillar 1 would come with its own set of anti-avoidance measures, wouldn't there be an overdosage of such measures, given the fact that at a domestic level, virtually every jurisdiction have been having domestic anti-avoidance measures? So there are questions around how the implementation of Pillar 2 will happen and whether that would result in an overdosage of anti-avoidance measures.
I think you're trying to move too fast. We are just now trying to elaborate the rules for Pillar 2, so let's do that. Will it have an impact on the behavior of companies, which could ultimately have an impact on the anti-avoidance rule? I don't know. What is for sure is that Pillar 2 will coexist with existing CFC. It's not a replacement of CFC and other anti-avoidance legislation. So I don't see in the first stage any, trade-off between a Pillar 2 and anti-avoidance rule, but you have the full Monty. Now, in the longer term, what will be the behavioral impact on companies and therefore on the use of the different instruments by tax administration? Hopefully, all these will achieve the work, complete the work that we've been doing for the past 10 years, which is to change the behavior of companies from extremely aggressive tax planning with kind of a tax fiction completely separated out from the business reality to a world where the tax function is no longer a profit center for a company.
Let me come to unilateral levies. The proposed EU digital levy, which has currently been put on hold, is being represented by the European Commission as not a digital tax. In fact, Ms. Vestager has said that the scope and purpose differs from the OECD tax deal. Is it possible that unilateral levies world over may take a different shape and form? And what is OECD considering any form of recourse to prevent such measures?
The question is a deal compatible with countries putting in place digital levies, whether you call them equalization taxes or levies, whether you call them a digital service tax, whether you call them whatever? And the answer is no. You cannot have a reallocation of taxing right, a very significant part of it coming from tech companies, and taxes which are targeted on tech companies. That's not compatible. And it's part of the deal. You will have seen that in the deal, you have a paragraph on the fact that unilateral measures must be put at a standstill or rolled back. Now, countries remain sovereign. And if a country wants to introduce a VAT on digital services, it's tax policy. It has nothing to do with the digital levy. If you want to introduce an excise tax on some form of transactions, as long as you have an extremely broad coverage in terms of scope and a very low rate, I don't see any contradiction with our deal. You have a fine line to draw at some point so that you don't try to get to a digital taxation, which would be contradictory to the deal. But I think that countries don't have that in mind. They want to act in good faith, and they do recognize that digital levies, if they are targeted to some companies, will trigger trade tensions, trade wars, and that's precisely what we're trying to avoid and why we have an agreement. So I don't see this as a very serious risk. So to summarize, digital levies, no. But overall excise taxes or VATs which are not targeted are instruments of tax policy and shouldn't be a problem. But Pillar 1 as well as Pillar 2 are really transformative and should pacify the tax relationship between countries, which means that digital levies will be dismantled.
Let me come to the next follow-up question, which is tax certainty for multinational enterprises. There's a growing concern on the level of tax certainty, particularly in the market jurisdictions, which are assuming new taxing rights, because the concern is how it will be implemented. It seems disputes around activities beyond baseline activities, which are beyond the marketing and distribution function, will continue to be an area of dispute in market jurisdictions. Is there anything as a part of the consensus process which is specifically addressing this aspect of multinational concern on tax certainty in the market jurisdictions?
Oh, yes, absolutely. Tax certainty is absolutely core to the agreement. So there will be no reallocation of taxing rights without tax certainty. And you know what? this is for the benefit of everybody. I've been struck for the past 25 years by the fact that some countries think that tax certainty can be traded or is contrary to the constitution or so. It is not. Actually, what is contrary to the constitutions of most countries is not to provide tax certainty, is not to provide a good visibility for taxpayers on what the rules are, is to expose taxpayers to rogue audits and audits which will never be solved through the elimination of double taxation. What can be done? I mean, first, we don't start from nothing, from scratch. We've had Action 14, a peer review mechanism, and progress has been made. We can see that there are more and more, in particular in India, APAs. And here again, I would like to congratulate the Indian government for all the efforts put there and the teams, Akhilesh Ranjan, who's now left the government, and Rashmi Das and his team. They've been great. Now, as part of the agreement, there are two new avenues. One is what we used to call Amount B, which would be a simplified measurement of the return on distribution activities. And we have a plan to complete Amount B by the end of 22. And the second one is the tax certainty dimension, which provides for mandatory and binding dispute prevention and resolution mechanism. Now, there are two dimensions. Dispute prevention. The Amount A will be decided through panels with all the interested countries and the companies, and this will bring very big tax certainty to the companies. Maybe a cumbersome process at the beginning, the initial investment, but actually it will pay off because all the countries will agree on Amount A, will agree on the nexus, will agree on the quantum. So that's something extremely important, which should reduce the disputes considerably. Now, there are still risks of disputes on transfer pricing or other aspects, and these disputes are covered by the agreement as long as they relate to Amount A. And what relates to Amount A is almost everything, except when you have an adjustment on a routine return on a company where the routine return could be allocated to another country where you have no residual profit. So that's quite marginal. And there you will have binding and mandatory dispute resolution. Now, we have agreement. We just need to turn it to write it in a manner where everybody feels comfortable. And we know that many countries think that their sovereignty is at stake. I think this is largely, I was about to use a bad word, which I will not use, but these are poor arguments, but assuming that countries are fearful to lose their sovereignty, there are manners to ensure that the competent authorities will be involved, will not be deprived of its understanding of the case and participation to the case. But at the end of the day, you need the elimination of double taxation, and there will be a panel with independent parties which will decide. You know what? 30, 40 years ago, European countries started working on a multilateral convention on tax certainty. And it took them 10 years to agree, and now they have something which finally works. So I'm pretty sure we can bring the rest of the world to something where people are confident. We will eliminate double taxation. It will happen in a fast manner, in a timely manner, and countries will not feel like their sovereignty has been completely ignored. We're getting there. We have an agreement, and we're very confident that this will be properly implemented.
Pascal, last few questions. What's the fate of few countries which are not a part of the inclusive framework and have not been onboarded in the two-pillar solution?
They are welcome to join anytime. Now, they decided not to participate to the inclusive framework, their choice. And frankly speaking, when I hear some critics say, oh, this is not inclusive because you don't have 200 countries around the table, this is a joke. This is a sick joke, because you have some countries which just do not have the resource to be at the table, and coming at the table would just delay everything and would not bring anything, because these countries, one or another, are represented by other countries. You do not have 200 different cases in reality. You have a few different constituencies. And, you know, when Rashmi talks, he largely represents large emerging economies. They participate. But when you have some African delegates like ATAF, which has done a great work, the African Tax Administration Forum, to coordinate the positions, do you need all the 50 plus countries from Africa? Not necessarily. Now they want to join, they're welcome to join. I think it would be important for them to protect their tax base through Pillar 1, through Pillar 2. Now, the more challenging issue is about those which are in the inclusive framework and didn't join the consensus. We have 3 European countries. We are confident that Ireland, as indicated, is part of the process, constructive, and at the end of the day may join, especially if the rate on Pillar 2 is to be 15%, which is probably likely to be at the end of the day. Estonia and Hungary will see, but Europe has to clean up its own place and bring these countries. Kenya and Nigeria, I feel very sorry that these countries did decide not to join. I think they will bear some responsibility not to bring money that they could bring to their revenue, but that's their choice. Can we do Pillar 1 and Pillar 2 without these countries? Yes, of course we can, and we shall do that. Now, as regards Sri Lanka, I don't know. We're in touch with them. And I'm not sure India wants to be involved in that conversation. You have your own issue with Sri Lanka. And finally, to be exhaustive, we have Barbados. Barbados doesn't want to join. I understand why. Can we do without them? Yes, of course. And that's why many low tax jurisdictions, in spite of this exercise to be costly for them, have decided to join. The Bahamas, Cayman Islands, Jersey, Guernsey, you know, countries which do not have taxes, which therefore are not big fan of what we've been doing, have decided to join as a recognition that the world has changed. And I think we should recognize this be happy with the fact that you have this fundamental move. 132 countries out of 139 is an achievement.
My final question, Pascal, what was, in your view, the most difficult areas to achieve consensus, and how many times did you actually feel you wish you had abandoned the project?
Actually, the more we could see doubts in people's eyes or minds, the more we were determined to keep this alive. So it's true that, you know, when in 2019, Steven Mnuchin, the then Secretary for Treasury in the US, said, well, I mean, safe harbor was a reaction to a proposal which was the unified approach, which we had designed to address most of the US concerns at that time. Yes, you could feel some discouragement, but we said we need to keep it alive because it will happen. So I think the main lesson of all that is you have mega trends, and the mega trend, I think, has been and still is on introducing this tax regulation of globalization. We're getting there. We're almost done. We now need the agreement to be finalized, implemented, and I think we will have turned the page. So when you believe in the fact that the rules are no longer fit for purpose, but that you don't have the magic alternative, which some have been claiming, you know, pure formulary apportionment method, unitary taxation as a magic solution, but that things are, changes will be incremental. We knew that it would happen one day or another. It was a question of timing. We've been fortunate with the Biden administration making this a priority. And that's why, you know, whether the deal is fully implemented with the legal instrument in the next 18 months, which I believe it will be, or not, doesn't change the fact that the page has been turned.
So in a lighter vein, should the amount A reallocation be termed as Pascal tax?
It's not a tax. You know, I'm a Frenchman with my French accent, and you know the French people are supposed to be in love with taxes. But Pillar 1 is not a tax. It's a better share of taxing rights, which will be exercised by the countries. So no PSA tax, including for amount A. Thank you for the suggestion, though, Mukesh.
Thank you, Pascal. I know we had reserved a limited time, but you've been more than generous to give us time. On behalf of the Bombay Chartered Accountants Society, I'd like to thank you from the bottom of my heart. And I wish you good luck on your negotiations. And I hope you get a much deserved vacation break, which I'm sure you would be looking forward to.
Thank you. Thank you so much. Good to see you, Mukesh.
Thank you, Pascal.
Right. So I thought this was a very engaging discussion